Welcome everyone to this wonderful occasion, which is the presentation of what is fast becoming a classic in value investing, expectations investing, the book by my colleague Michael Mauboussin and Alfred Rappaport, now in its second edition. It's quite a pleasure. Michael needs no introduction to this community. He will get one nonetheless. He is, of course, the head of consumer research at Counterpoint Global inside Morgan Stanley, but most importantly, and has a distinguished career in investment. But most importantly, as many of you know, he's a valued member of our community, a key person inside the Helpline Center for Graham and Investing, and now my co-host in the Value Investing with Legends podcast. He's a star teacher. And, let me tell you this anecdote before I hand it to Michael. Whenever I get together with the Dean for Faculty, Ken Daniel, the first item in our conversation is always, how can we get Michael more involved, even more in the life of the business school? He is simply an inspiring figure, not only for our students, but also for our faculty inside the Helpline Center. And we hope his leadership will stay with us for many years to come. And Michael, thank you so much. The floor is yours. And thank you so much for your leadership in the center.
Everybody joining us online, it's an absolute pleasure to be here. It's a special bonus for me tonight that I'm joined by my wife Michelle and my daughter Isabel, so they rarely get to see me in action, so it's great to have them here. I had a professional epiphany probably about 35 years ago, and I can draw an arc from that moment to this moment right now. I was a liberal arts major in college, never studied any business. In fact, I took one business course called Accounting for Non-Business Majors and got a C in the class out of the generosity of my professor's heart. So I came onto Wall Street, and it was a very confusing time. Lots of rules of thumb, lots of old wives' tales, lots of stories being told, and none of it really made much sense to me. Right around that time, this is the late 1980s, one of my colleagues in my training program handed me a copy of Creating Shareholder Value by Al Rappaport. And this was my professional epiphany. Rappaport made 3 points in that book, which remain at the centerpiece of everything I've done research-wise in the last 35 years. The first is, it's not about accounting numbers, it's about cash. And we're going to talk about that today, specifically in the context of expectations investing, but it's a lesson we seem to learn and relearn from time to time. The second thing is, and I really appeal to the students on this is very important. The second thing he said was, competitive strategy and valuation work have to be joined at the hip. Even within our hallowed halls, we tend to teach these things separately. You take your finance courses and you learn about cash flow models and Black-Scholes and all that wonderful stuff. And then you shuffle down the hall and you learn about strategy. Now, the key is these really do go together. In other words, the litmus test of a quality strategy is that it creates value. And you cannot do a thoughtful analysis or valuation of a business without understanding the competitive positioning. So he really wanted to draw those two concepts together. And the third and final concept was chapter 7 of the original book, and it was called Stock Market Signals for Managers. And the argument is, if you're an executive, you really need to understand what is being priced into your stock if you want to make good, judicious capital allocation decisions. And very few executives did, and actually today do that effectively. So I started employing those ideas, and that got me to eventually meet Al Rappaport. I met him first in May of 1991, so a little over 30 years ago. It was a real thrill for me to even shake his hand. And that led to our first version of Expectations Investing, which came out, drum roll please, September 10th, 2001. Can you pick a worse day? Day before a national tragedy in the middle of a 3-year bear market. So when we signed the contract for the book, times were roaring, things were great. By the time it came to actually getting the book out, it was really problematic. What I'd like to do tonight is just talk about 3 things. Four things, pardon me. One, talk a little bit about the big idea. Second, talk a bit about what drives value. And here I want to talk a bit about this distinction between earnings and cash flows. Third is ask a simple question is, why doesn't everybody do this? And we'll talk about the history of the concepts. And then fourth, how do I implement the process? And I promise you I'll do that quite quickly. So I'm not going to bore you with the details. If I've done this job effectively, we'll get through this pretty briskly. And certainly for the folks here in the room, I would really love to hear any questions or comments or thoughts you have. So we'll open it up for a fun dialogue. So the big idea here is quite straightforward, which is investing, like a lot of things in life, relies on expectations. Ever had an experience something like this? You're walking across campus, you bump into a friend, and a friend says, how are you doing? And your friend says, I just watched this series on Netflix. It's the most awesome thing I've ever seen. You got to stop what you're doing and watch this series. It's awesome, right? You're like, all right, cool. So get all geared up for it. You turn it on and you watch it and you're like, it's good, but it's not the greatest thing I've ever seen. So your expectations were built right up and maybe they came up a little bit short. So there's a simple equation I always like to use. Satisfaction equals results minus expectations. And that's a pretty universal equation you can use for lots of things, but certainly in the world of investing. Second, it is revisions and expectations that cause stock prices to change. That's almost a tautological statement, but we'll try to delve into that in some more detail. And the key task for the investor is to anticipate those expectations revisions. So the first questions that come right up are expectations about what? What do we care about? Second is, are all expectations revisions equal, or are some more important than others? And more importantly, how to identify what really matters for a particular business? And finally, what's the best way to go about this task? So let me answer these questions right up front. Expectations are appropriately based on the company's long-term cash flows. I don't think anybody theoretically disagrees with this point. The challenge is, how do we implement this from a practical point of view? Second is, expectations revisions are absolutely not the same. Some are much more important than others. We want a very systematic way to figure out what matters for any particular business. And third, riffing off what I mentioned with Rappaport's work, investors need to combine the tools from competitive strategy and finance to intelligently anticipate what's going to happen next. And I think, by the way, Tano, in your course and your teaching, you very much do this as a part and parcel of the approach in value investing here at Columbia Business School. Now, one of the things I was thinking about is how the world has changed in the 20 years. And many of you here in the room certainly were very young when the first version of this book came out. So I was curious about, how has the world changed from then to now? So I looked at something very simple, which is the top 10 companies by market capitalization at the end of August in 2001 and the end of August in 2021. So the first thing you note, which is interesting, is only one company is on both of those lists, Microsoft. And by the way, it's an interesting question you might ask yourself. If you fast forward and we reconvene here in 2041, would you expect some of the companies that are the titans today to be on that list 20 years from now? The other interesting thing is 4 of the list of the companies on the top 10 list for 2021 were not public in 2001. And 2 of the 10 did not exist in 2001. So this just gives you some sense of how much the world changes in a medium period of time. Now, to give you some sense of how much expectations change, look at the change in market values of the businesses from 2001. Collectively, they lost, collectively they actually went up a little bit if you include Microsoft. If you take Microsoft out of that picture, collectively they lost $460 billion of market value. In fact, if they just from a capital appreciation point of view kept up with the S&P 500, they would have been worth $6.7 trillion more than they actually were. So it's a huge opportunity cost and obviously a huge revision in expectations. Likewise, the value creation for the top 10 today was absolutely stunning. Apple's market cap in August of 2001 was 7 billion with a B. It is today about 2.5 trillion. Microsoft's market cap, 300 billion, today about 2.3 trillion. Amazon, about 7 billion, today about 1.7, 1.8 trillion. Huge revisions in expectations over that 20-year period. The other thing is interesting is the shift from tangibles to intangible investments. And I'm going to give you a little more of a deep dive on this in just a moment, but this is interesting to look at this 20-year span. What you can see is back in 2001, they basically started at the exact same level. You can see that intangible investments and CapEx were about the same, right around $630, $640 billion. Fast forward to the estimates for 2021, and we see a complete reversal. Today, intangible investments are going to be roughly double those of CapEx this year. By the way, for all of you students, this is incredibly exciting. because these intangible investments show up by and large on the income statement. And if you have a way to think about these more effectively than other investors, the world is going to be yours. This is a very exciting frontier, I think, of understanding businesses. And I think we can lead the way in understanding them properly. The third thing, which really doesn't have to do with the expectations approach, but just about the world in general, is how the discount rates have changed. These are estimates by Aswath Damodaran, who is one of the leading guys on this and gives monthly estimates of the cost of equity. You can see back in 2001, that number was 8.5%, and now today it's about 6%. 8.5, by the way, it turns out to be a commodity multiple of something like 12 times, right? If you just 1 over 8.5, something like 12 times. Today, 1 over 6% gets you something more like 17 times. So the baseline multiple for the market because of this has gone up quite meaningfully. But there's a second feature, a couple other features that are really interesting. Note that even the key driver of this decline was the risk-free rate, the 10-year Treasury note yield going from 4.9% to 1.3%. It's a little bit higher now. I made this slide last week. Today it's about 1.5%. But note too that the equity risk premium's actually gone up. And interestingly, this is in contrast. So I looked at the BBB credit spread, and that was 2.1% in August of 2001. And now it's about 1.1%. So credit spreads are down, equity risk premium is up, if you believe these numbers. So that would argue, all things being equal, equities are actually even more attractive today, relatively speaking. Last thing I'll just say, if you believe the 6% number or something in that neighborhood, historically, equities have returned about 6 to 7% real in the United States, so inflation adjusted. The inflation expectations today are a little over about 2.3%. So that would mean that equity returns will look like something like 3.5 to 4.5%, which is relatively speaking very, very modest. Okay, so let's shift gears a little bit and talk about what drives value. This goes back to the very building blocks of business. I should mention I grew up in central New York. My father was a car dealer, so a small business person, and I knew very intimately from a young age what exactly drove value. It was the cash in his bank account. He thought about cash and as what the wealth is for him and what our family's wealth was. So they're basically, to value any business, you have to ask and answer 3 questions. How much money am I getting? Second question is, when am I getting my money? And the third question is, how certain is it that I'm going to get my money? So we can translate these a little bit more formally into the concepts of cash flows, risk, and some sort of forecast horizon. Now, if you are involved in credit, if you're involved in real estate, you know these things. By the way, in credit, these things are 2 of these 3 things are contractual, so we know what they are. Real estate, this is very much how people do things. The challenge in the world of equities is that these are all based on expectations. We actually don't know the answers to any of these questions. We have to make our best judgments as to what they are. We talk a little bit more formally about, I apologize, a little bit busy, but a little more formally about cash flows. The number we care about is on the far right, which is free cash flow, which is a cash available for distribution to all the claim holders of the business. And that in turn is the difference between net operating profit after taxes. So basically think about some measure of income and investment in the future. Typically working capital changes and CapEx are taken into consideration. So there are really 2 points I want to make on this. The first point is that a lot of the investment community and certainly the corporate community and certainly the business press is very income statement centric, right? If you turn on CNBC and there are earnings being released, what you're going to see are things like sales growth rate was X, maybe some discussion of margins, and earnings per share were Y. That's going to be the focal point. And of course, as you know, and certainly as students at Columbia Business School, you know that understanding the magnitude and investment in the balance sheet and having a crystal ball as to what the returns on capital will be gives you a better sense of what the future earnings of the business are, right? So I think we're all good on that, but just understand that balance sheets are very important as well. The second point is, our global economy, and this is what I want to spend a few moments talking about, our global economy continues to shift from one based on tangible investments to intangible investments. Accountants have not kept up with us. So intangible investments show up by and large on the income statement, not on the balance sheet. So now we're conflating these 2 components. And one of our tasks is to disassemble those 2 pieces to understand them more accurately. So just a little bit of a riff on intangibles to get you going on this. Here are the data going back to the 1970s. By the way, I already mentioned my epiphany happening 35 years ago, but you can see that tangible investment was comfortably above the level of intangible investment even when I started in this business. So within one person's career, we've seen this extraordinary change. So back in the 1970s, tangible investment, and this is measured versus gross value add. You can just think about this as basically GDP. Tangible investment was double that of intangible investments, right? So tangible defined as physical things you can touch and feel, think factories, think machines, that type of stuff. Intangibles, by contrast, and when you think intangibles, again, things that are not physical, think brand building, think training for people, think software, that kind of stuff, was again half. And then you could see this migration to the point where today that relationship is essentially flipped, right? So within one business career, we see this watershed change. Tano, I'll point this out. I think one of the things I find fascinating about this is the crossover point is almost exactly when the Fama French paper came out in 1992, talking about a multi-factor model featuring, for example, the value factor, which is based on price to book. So almost the moment that ink dried on that, showing how price to book was an effective way to generate excess returns relative to CAPM, is when we've had this major transition. So here's, I think, the money slide of this discussion, which is taking a look at the components of SG&A going back again to the 1980s. This is for the Russell 3000, so effectively all the companies that are public in the United States. The intangible investments we estimate this year will be something like 2 trillion. I just told you, but this last year that we have recorded is about 1.8 trillion. Right now, to give you some sort of level set, CapEx is about 900 billion, so that's that 2-to-1 ratio. And of the 1.8 trillion, R&D is about 450 billion. So it's only a quarter of it. So when people say, oh yeah, I've got the intangibles covered, I've looked at R&D, recognize they're missing 75% of what's significant in the whole calculation. So this is, and by the way, this is hard to see, but you can take my word for it, that since the financial crisis, for reasons I'm not sure I can explain, the slope is actually accelerated for the intangible investments, right? So describe very quickly what this is doing is breaking down SG&A into two pieces. One is the investment piece, intangible investments, and the second is the maintenance piece, which is how much money does the company have to spend in SG&A just to keep the trains running on time and getting the mail delivered? Right, so this is a very interesting question for you all as you're doing analysis, and a super interesting question when you talk to executives, which is when you think about your own income statement, how much of it is maintenance related, again, to keep things running, and how much of it is discretionary investment in pursuit of value creating growth? And see if those executives can answer those questions. By the way, many of them struggle to, interestingly. Let me make this a little bit more concrete with a specific example. I'm going to use Microsoft, which is obviously big and been around for a long time. This is just a calculation of Microsoft's. Let's see if I can even use this. Here's Microsoft's, we'll just use 2021. So you can see their EBITDA was about $73 billion. It's an incredible company, by the way. Cash tax is about 10 billion. And so their NOPAT was 62 billion. This is a standard way we do this out of a standard finance textbook. And then we look at their investments was about $20 billion. So 62 minus 20 is $42 billion of free cash flow. That was Microsoft's actual, they're on a June fiscal, that's their actual number. Right, so remember that $42 billion, because that number is not going to change. But we're going to see how we get to a very different picture when we start to think about reflecting the intangible investments. So when you want to capitalize intangible investments, there are two big discussions you need to have. The first is which and how much of each SG&A item will be considered to be an intangible investment. And the second big question is, over what period of time do I amortize that? Those are the big questions. In this, I punted a little bit and I deferred to the work of a guy named Chuck Hulton, University of Maryland. He's a very prominent guy in this field. He wrote a paper about Microsoft specifically, so I just used his formulation. And what he argued was essentially all of R&D should be considered to be intangible. By the way, I think that would be debatable. I think the number should be lower than that. 70% of sales and marketing and 20% of G&A. And then he attributed a 6-year horizon for R&D, so an amortization period, and 2 years for both sales and marketing and G&A. So note that in 2021, their total SG&A was about $46 billion, but what we're saying is about $36 billion of that is actually investment, right? So a very, very different picture when we think about it, if these numbers are valid. So now we can rerun our numbers. We have to create a schedule to look at the amortization, but just to get to the punchline, what you see is that net operating profit after tax goes from $62 billion. Now the adjusting, again, we're shifting that investment piece away from the income statement and we're placing it back on the balance sheet. That goes from 62 to $69 billion. So that's a 10% increase. Now, Microsoft's a big, very profitable company. And you guys know that around 40% of companies in the United States today lose money. You can lose money for one or two reasons. One is the old-fashioned way, which is your expenses are greater than your costs, and that's bad, or your revenues, and that's bad. The second way is that your investments are happening on your income statement, and those investments have very high returns on capital. So as a consequence, you want to do as much of that as you possibly can. And so those losses are actually not at all an indication of ill health, and in fact, maybe an indication of wonderful health. So you can imagine the lift is actually much bigger, but it's 11% here. And then you can see that the investment goes from $20 billion to $27 billion. So a very substantial lift, 35% lift there. But again, the free cash flow is the same. So you might say, why all this effort if the free cash flow doesn't change? The answer is, again, analytically, if I'm trying to understand businesses, I really want to categorize what is investment, what is profits, and so forth. I won't go through this in any great detail, but suffice it to say, you can do these same calculations for the balance sheet and calculations of invested capital. So in this case, invested capital classically calculated is about 120 billion. Invested capital, including all these adjustments, goes to 206 billion. So Microsoft, people say it's a capital light business, but the argument here is if you're properly reckoning for the investments they're actually making, they're investing actually a great deal more than people perceive based on the simple income statement. By the way, that means their ROIC drops from 58%, which is spectacular, to 37%, which is still pretty spectacular, not quite as spectacular, but a much more, as a business person, you say that feels a little bit more like something that makes sense versus those much higher numbers. Okay, so next discussion is, gee, this all seems fine so far. Why doesn't everybody do this, right? If this is such a clever way of doing the world. Warren Buffett has said a number of times that there are really only three things you really need to read to be a great investor. The first is chapter 8 from The Intelligent Investor. And as you may recall, chapter 8 is the concept of Mr. Market. So this is the idea of how do prices and value get separated from one another and why. And again, he's endowing the market with almost these psychological behaviors, but it's a very, very good way to think about the market getting too optimistic or too pessimistic about the prospects of either a company or the market overall. The second reading he recommends is chapter 20 from The Intelligent Investor, which is about the concept of margin of safety. Right? So whenever I buy something, I want to make sure that I'm paying substantially less than what it's worth. That will accommodate, errors in my own judgment and bad luck. Right? And so if I do this sufficiently well, I will do well. By the way, one thing I learned, I didn't know this, I just learned over the weekend, is that the idea of margin of safety was developed by Moody's in their bond analysis. And so it's actually, the original idea of margin of safety was just a coverage ratio, interest coverage ratio. And then that was taken by Graham and others, interestingly. And then the third chapter is chapter 12 from Keynes's general theory. And chapter 12, as you might know, is called The State of Long-Term Expectation. And it's just a beautiful, it's behavioral finance before behavioral finance existed. And Keynes has one line in there I'll just draw out, which says the actual results of an investment over a long term of years very seldom agree with the initial expectations. Right. So again, not a shocking statement, but something that's important for us. I guest taught a class for Jonathan Nee's digital investing class a couple of weeks ago. And at one point I did a little survey of how many people had heard of John Burr Williams. And I was surprised to hear that no one had heard of John Burr Williams. And that's an unfortunate thing. I don't think we should let anybody collect their diploma until they've heard of John Burr Williams at least. John Burr Williams wrote a very seminal book in 1938 called Theory of Investment Value. By the way, what a title, right? Theory of Investment Value, like gives it to you right there. By the way, Warren Buffett first talked about John Burr Williams's book in 1992. So if you go back to the Buffett 1992 letter, you'll read about John Burr Williams. And there, Williams really laid out the dividend discount model. The cash flow models we use today are essentially derivatives of what Williams laid out in 1938. But what I love to mention is that he goes through this whole theory, and then in chapter 15, it's called A Chapter for Skeptics. Now, in the world, even today, there are lots of discounted cash flow model skeptics. And it turns out that John Burr Williams addressed every one of those concerns pretty much head on in 1938. And there's not that much that's actually changed. So the kinds of things he tackled, are these formulas too intricate? Are these formulas too long-term oriented? Are these formulas too impractical? Are these formulas corroborated by actual experience? So again, he systematically covers each of these. But he's got a nice little phrase in here where he actually introduces expectations investing. He says, those who feel it unsound to use these long-range forecasts may still use the new formulas another way. They may use the actual market price as datum. Then they may deduce the growth that's implied by the actual market price and see whether the prevailing price is reasonable or not. Right, so this is written in a little bit of 1930s language, but the point is spot on, right? John Burr Williams got this many, many years ago. One of the other metaphors I find very powerful for this is thinking about horse racing. If you ever look at handicapping, there are really two essential components to it, right? One is determining how fast the horse is likely to run in a particular race. And the second is what is priced in on the tote board. And the job is not to find winners, because if it's all priced in, you're not going to generate excess returns. The job is to find mispricings between what's priced in and how the horse is actually going to run. For my students in security analysis, the very first day of class, I assign a few classic Ben Graham readings, but I also assign a 13-page essay, chapter from a book by Stephen Christ. It's called Christ on Value. And I'm going to argue that that 13 pages is among the best 13 pages you'll ever read about investing, even though it has nothing to do with the stock market. So Chris, by the way, himself a very interesting guy. He grew up in New York, was a very accomplished pianist, even as a young person, played in jazz bars, even before he could drink. Went to Harvard, was like a Renaissance literature major, some sort of crazy thing. And then one day he was at the Harvard Crimson, and then one day, no, I think it was a Harvard Lampoon, pardon me. And one day, one of his colleagues said, "Hey, Steve, there's greyhound racing. Would you like to check it out? Dogs." So he goes, and he immediately falls in love with this idea of racing and handicapping and so forth. And that parlayed him to become the New York Times correspondent for horse racing. So this is a little bit long, but I want you to, I'll mostly focus on what's bolded, but I want you to mentally, as you go through this with me, strike the word horse and insert the word stock and see if it still applies, right? The issue is not which horse in the race is the most likely winner, but which horse or horses are offering odds that exceed their actual chances of victory. This is really important. He says, this may sound elementary, and many players may think they are following this principle, but few actually do. There is no such thing as liking a horse to win a race, only an attractive discrepancy between his chances and his price. Says it perfectly. The other legendary investor who did this was Michael Steinhardt. He wrote a biography, autobiography or memoir 20 years ago. And he had this concept of variant perception. And again, the term that many of you are familiar with. He said, I define variant perception as holding a well-founded view that was meaningfully different than the market consensus. Again, in bold, understanding market expectation was at least as important as, and often different from, the fundamental knowledge. Now, here's a really interesting thought experiment. How about we set up a research department that it has two different parts to it? The first part of our research department is simply going to say, here's a stock price. What is priced into today's stock, right? They're simply going to figure out the odds or what has to happen for that stock price to make sense. And the other half of our research department is just going to be business analysts. They're just going to study businesses and project what they think are reasonable sales growth rates and profitability and so on and so forth. And we're not going to let these people talk to one another until the very last moment to see if they do or do not agree with one another. The problem is most of us have both these things in our head simultaneously, and we conflate these two things without really separating them as effectively as we could. Every great investor I know understands fundamentally the difference between expectations and fundamentals. And I think one of the biggest mistakes we make in our industry is we don't make that distinction carefully enough. In other words, when stocks are going up, we want to buy them. And when they're going down, we want to sell them. And we lose track of what's going on with expectations. So why doesn't everybody do this? Another thing I'll just say is the most common approach is to estimate value via multiples or some sort of model, but multiples are obviously the dominant thing. There was a large CFA survey done a few years ago. They talked to 2,000 CFAs, and well over 90% of them say multiples are the primary way that I value a business. Now, part of that is, I think that you're in control when you're doing that. You're saying, I think it's worth X multiple of sales or Y multiple of EBITDA. But again, it's not natural for people to go backwards. Second is investors are wary of discounted cash flow models. We've already talked about that, even though John Burr Williams addressed it in 1938. But people say things like, gee, just change small tweaks in some of the assumptions, change the values a lot, and that could be problematic. And then the third thing is I'll say, which is really important, is people don't use available tools, such as the expectations infrastructure, which if you don't know what it is, I'll tell you in just a moment. and things like base rates. So there are things that we know already out there that are just not being tapped. And I'll just say the sooner you tap those things, the more effective you're likely to be. Okay, so this is the last section, and I'll be fairly quick on this. How do I actually do this? This is obviously a very high level sketch. There are really 3 steps in the process, which by the way are very logical given everything I've said already. Number 1 is understand price implied expectations. I'm going to tell you more about that in just a moment. Second is identify expectations, opportunities. And then third is make your buy and sell decisions. So step 1, how do we do this? What we're doing is using a sound cash flow model, right? So we're mimicking first principles. But in this case, we're not forecasting what we believe. We're essentially asking, what is priced into today's stock? Now, we can be guided by things like consensus forecasts. There's certainly a component of art in this, but you're basically saying, what do I need to believe to justify today's stock price? And by the way, this step is best done with you being agnostic. In other words, you're suspending your view one way or another. You just want to say, what do I have to believe? You know, so for example, Warby Parker went public today, a direct listing. You'd ask, what do I have to believe about the prospects of Warby Parker to justify today's stock price, right? So, and then you're also avoiding many of the shortcomings of traditional valuation methods, including multiples. Second step is identifying opportunities, and that's going to have a couple components. The first is understanding historical results, and that's obviously usually a good starting point. Then you're going to do your strategy analysis. I'll show you more about that in just a moment. And then here's the next thing that's really important, which is figure out which trigger matters the most. Now, let me just give you a heuristic that's very, very useful. It sounds incredibly simple, but it's very useful, which is if you are analyzing a value creating business and you're sure that's a value creating business, you should understand that that business is going to be incredibly sensitive to incremental growth. You're going to turn your lens and your focus on growth. By contrast, if you're looking at a value neutral business, you're going to focus a lot on incremental returns. You're not going to worry about growth so much. You're going to say, how do they get this righted in the right direction in terms of economics, and then go from there. In terms of strategy, and this is dedicated in chapter 4, very straightforward stuff, very Greenwaldian, by the way, in process as well. So we do the 3 steps: lay of the land, which is things like industry maps, value pools. I like to do, I didn't put it on here, but I love to do entry and exit analysis. I think that is way underutilized. People don't do enough thinking about who could come in, who is leaving, and then other external forces like government factors and so forth. The next step is industry assessment, classic Porter 5 forces, which I still think is a very valuable exercise, and studying whether there's a risk of disruptive innovation. So Clay Christensen's work. And then finally, firm-specific source of advantage. If this company indeed I do think has a competitive advantage, I should be able to articulate what is behind that and why it drives returns on capital. Differentiation versus low-cost producer, by the way, another very simple rule of thumb. Again, you guys know this stuff, but if you break down an ROIC in terms of a simple DuPont, it's going to be basically margins times capital velocity. If you have a low margin, high capital velocity business, you're going to go right to your low-cost producer checklist. If you have a high margin, low capital turns business, getting the same high ROIC, you're going to go right to your differentiation checklist, right? So in other words, just knowing the decomposition of ROIC, presuming that it's attractive, allows you to understand the nature of the type of business that you're dealing with. And then of course, value chains, which allows you to compare one business to another. Now, here's one thing I'll nerd out just for a moment on this, and I'll tell you a very quick story. So the original version of expectations investing, which we were working on more than 20 years ago, my colleague, Al Rappaport, who is incredible, still is incredible, had a competitive advantage in every chapter. So we outlined the book, but he was going to be better in everything than me. But we tried to say, all right, where might I have a comparative advantage, right? Like where I could sort of hold my own. So we had 16 original chapters. We ended up being 12, but we had 16 original chapters. 8 were his, 8 were mine. And I had a bunch of chapters, which I was really excited to write about. One was, let's talk about sales-driven companies, where sales is a more support. So I was like, all fired up. And I actually wrote that chapter, and I thought it came out great. So I was very excited. And then the next chapter I was going to write, I was about margin-driven companies. And then I was going to finish with a trio with investment-driven companies. So I'm sitting down to write the margin-driven company thing. I'm really excited about this. And I realized right away that I'm stuck. Because whenever I asked, why do margins go up or down? The answer was almost always, because sales go up or down. So I realized there was a fundamental interactivity between these value drivers that I had not teased out before. And by the way, the vast majority of any operational sensitivity analysis I've ever seen since does not take this into consideration. So I handed the problem back to Al, and he sharpened his pencils, and he actually worked with a lot of microeconomists, and we came up with what we call the expectations infrastructure. So on the left, what we call value triggers, sales, costs, and investments. Every business, everywhere has those three components. The problem is they're too broad to map to the value drivers, which drive your discounted cash flow model, and we have to refine them through the so-called value factors. So these are 6 microeconomic drivers of the ultimate value drivers. The first 2 are very common sense, volume and price and mix, and I can talk more about those if anybody would like. Number 3 and number 4 are interesting because they often get conflated in our day-to-day conversation. So operating leverage and economies of scale, and people usually use those things interchangeably, but they're actually very distinct concepts from an economic point of view. So operating leverage is the concept that you build, is basically absorption of pre-production costs. So you built a factory that can manufacture 50 widgets. Today, you're only manufacturing 50 widgets. So I'm part of 100 widgets, now you're 50 widgets. As you go from 50 to 100, you're absorbing those incremental costs and profitability goes up. So it's absorbing a pre-production cost. Economies of scale, by contrast, says I can do something cheaper as I get bigger. So your scale and your size alone allows you to do things cheaper, right? Whether that's better terms with your suppliers or what have you. And then cost efficiencies, I bring them in only because they're independent of sales. So it doesn't matter about sales. And then investment efficiencies. So note that because 4 of these value triggers are spurred by, 4 of the value factors are spurred by sales, you know that sales for most companies is going to be the most important thing. So here's the interesting question and challenge for all of you is you look at a business and you're studying business and you want to understand the history of it. Can you understand it through this lens? And much more importantly, as you're doing sensitivity analysis in the future, how do you apply these ideas? Before you leave this slide, the objective is to say, let me think about what is the most important trigger. The vast majority of the cases is going to be sales. And then let me think about plausibly the best case scenario, the worst case scenario, and something in between. And by the way, I don't like bull bear bait. You should have more than 3 scenarios, but you get the idea. You want to think about stretching how good the world could be and stretching on how bad. And then once you have those revenue numbers in hand, then think very carefully and thoughtfully and based on some grounded in some history, how the value factors are shaped and what that means for the business. That allows you then to have scenarios, probabilities and scenarios. And then the final step is just make buy and sell decisions. If you're doing that last step properly, you're going to have, again, these outcomes and probabilities associated with them that allows us to estimate expected value. And that allows us then to buy at a discount to that, which is where we get margin of safety. Sprinkled throughout all this, which I didn't get into in any great detail, are concepts of how to manage and mitigate behavioral mistakes that we're likely to make. So you want to also make sure that you keep that in check. The case study in this book was Domino's Pizza. By the way, the case study for the first book was Gateway 2000. Anybody remember that company? It actually didn't exist much longer than the book. And so I'm really hopeful that Domino's will be around for a long time. But as many of you know, it's a great business and it's a pretty cool thing. A couple other features in the book that are beyond the traditional stuff. I'll mention two or three things. One is we have a chapter dedicated to the concept of real options. For the vast majority of businesses, the truth be told, discounted cash flow models and traditional multiples are going to get you where you're going, but certain types of businesses really lend themselves to real options. And the characteristics, and again, think about these almost as a checklist, would be uncertain markets. So you need a lot of volatility. As many of you know, right? Volatility is bad for discount rates, but it's very good for option value. You want a capable management that knows how to understands how to identify and then execute options appropriately. Market leaders are helpful because usually they get the first call for opportunities. And then finally, you need access to capital. You might have great options, but if you can't fund them, they're for naught. The original version of the book, our real options case study, was Amazon.com. That ended up being very prescient, lucky probably more than prescient, but certainly that was good. The one we used in this book, actually, and we did this about a year ago, was Shopify. Shopify was like $900, and now it's at $1,300. So far, that seems to be playing out reasonably well as well. And then the other concept is reflexivity, and I think that is continues in these markets to tend to be very important. So we tend to think about the value of the business as independent as the stock price, right? So the value, the business itself is sort of in the real world, and the stock price is sort of this assessment of the real world. And George Soros and others have argued there's this concept of reflexivity, which is there's a feedback between the price of the stock and actually the fundamentals of the business. Probably the poster child for this is Tesla, right? So even Tesla has struggled along, but as the stock went up, that increased people's confidence in it. And in fact, the company could sell some equity that allowed them to finance, and that allowed them to do more stuff, and you got this positive feedback. So this idea of reflexivity should never be left out. By the way, you could argue on the fringes that it's relevant for the meme stocks, but like AMC Smart stock goes up, they sell a bunch of it, right? Which gives them more optionality. But the idea of reflexivity is really important. I already alluded to this, but this is also very important. We have a chapter on, we call it Cross the Economic Landscape. And this is just to note that you can think about physical businesses where physical assets are the source of value creation, service businesses where people are the source of advantage, but the key is they deliver their service one-on-one. So think about your accountant or your lawyer or your hairdresser. Those are service businesses, one-on-one, doesn't scale. And then the last is knowledge, where again, people are at the core, but they create content once and they replicate it many, many times. So you might think about your favorite band. When they're recording in the studio, they're making a knowledge good. When they're on tour, it's a service good, right? They're one-on-one. And so the key is that these all have different qualities and features. And as I've mentioned, the economy is shifting, and even companies that started as traditional physical businesses have migrated or tried to migrate across the spectrum from service to knowledge. And that has implications about the value creation and stickiness and so forth. Two final thoughts. One is on capital allocation. We have two chapters dedicated to this. One is on just mergers and acquisitions. And the simple argument is that most of the metrics people use, including investment bankers and companies, about earnings accretion and so forth, is a very poor way to think about the value creation prospects of an M&A deal. And then we have a chapter on share buybacks. Share buybacks, for some reason, is the most misunderstood concept. Like, there are people who go out and say crazy things about share buybacks. But share buybacks are obviously a very important factor now in capital allocation. We talked about what we call the golden rule of buybacks. And we do try to address some of the impure motives that companies might have for buying back stock. And with that, I'll end. I'll just mention that we have a website which is available now. You can go check it out, called expectationsinvesting.com. This is just the basic thing, but I'll mention the thing that may be of use to you all. If you go to the website, on the right-hand side in the menu, there are online tutorials. And here there are 10 tutorials, each of which includes a downloadable Excel spreadsheet. So for example, you want to see how we did the Domino's pizza analysis in the book. You go to tutorial 8, you'll read about it, and then you'll have a spreadsheet. You'll click on it and you'll see the exact same numbers in that spreadsheet as are in the book. Well, you can use that spreadsheet and modify it for your own purposes, so on and so forth. So the idea is to say there should be no number you look at the book, go, where'd they come up with this? Everything is going to be reverse engineered to some degree. And so with that, I'll stop. And I'd be very happy to take questions. I'll say one thing, Meredith, this is for the people in the room only. So I want you guys to stick around even when we're done officially with the broader thing. We've had, people talking about supply chain problems, and we have a big supply chain problem with getting copies of the book out to the world. And so Amazon was supposed to ship this in early September, and we're still waiting for the books. But I did get some author copies, so I brought 5 of them with me. So here, and I want to give them to you guys, or some of you guys. Okay, so here's what we're going to do. And maybe I'll hand this out now. You can just, but now please, we have an honor system, right? Everybody sign the honor code. So you need to sign, you got to live to your honor code, right? Do not Google any of these answers, right? So what I'm going to do is hand out a sheet. I'll just start here. Just take one and on the honor system and circle your answers. And then when we're done, I'll see who gets the best grades, and then we'll hand out some copies. So Meredith, so anybody in the room, any questions or comments or thoughts, or you guys just thinking about how to answer the questions? Hey, Parker, yeah.
Yeah, thanks, Michael. I'm just kind of curious, like when we think about, especially like software businesses or just kind of like tech in general, you hear so many say like just price to sales is what they care about, not even like price to gross profit. Everything you're talking about is on cash flow. So I guess since you kind of initially wrote the book at another hot time for tech, could you kind of speak to how these perceptions kind of adapted in the wake of that sell-off, and perhaps like when you think even like kind of more SaaS or software-oriented investors might come back to this type of framework?
Yeah, it's a great question. And I'll just first say that we wrote a piece not too long ago called "Everything is a DCF Model." I sort of try to address that to some degree. So let me just back up one second and just say that in our course in security analysis, we spent a fair bit of time on this, which is to say that multiples are not valuation, right? Multiples, like nobody here is listening anymore. Multiples are a proxy for the valuation process, and you should never confuse those two things. So I think what happens is when things get elevated like they are, well, certainly 1990s. I think today it's actually not like that. People start to rely more and more on these heuristics without going back to the basics of this. Now, that said, the question, we can very much translate this into expectations investing type of language, right? Which is, if a company's at 20 times revenues or 10 times revenues or 30 times revenues, what do you have to believe about that business to make it justifiable? Now, I'll just say if it's an intangible based business, and you mentioned SaaS in particular, there are a couple features that are quite distinct, even from the 1990s. Number one is they're digital, right? Which means that they can scale incredibly fast. And we've seen businesses do that. Second is many of these businesses are global in nature, right? Which means that they can grow, the total addressable market can be much bigger than it was in the past. So again, not to be make excuses, but just to say like what has to happen for that to make sense. So I would try not to lose sight of this. And this is why this is my whole thing is I would always like to say, by the way, it's got two sides to the back to. You have to earn the right to use multiples. And when I say you have to earn the right, that means that if you say 20 times revenue is appropriate for XYZ, you understand the economic implications of what has to happen for that to make sense, right? Otherwise, you've just lost your grounding. It's a great question, but that's how I'd answer that. Thoughts?
Others in the room before I take some of the online questions? Okay, Michael, this comes from an alum, J. Dennis John Jocks. He says, in your original 2001 book, part 3, Reading Corporate Signals, you identified certain potential catalysts such as M&A activity and buybacks, but you also touched on incentive compensation. My question is, did the proliferation of investors focus on hard catalysts and the popularity of ESG investing impact how you view expectations?
All right, so read that last section again. So
did the proliferation of investors focus on hard catalysts and the popularity of ESG investing impact how you view expectations investing?
Well, gosh, I don't want to say the answer is no, because it's a very thoughtful question. And let's parse that a little bit. I think compensation is very important. Incentives are very important, right? So let's just take the obvious incentives. And I will say one thing, that the original version of the book had a chapter 12 was all about incentive compensation. We actually moved away from that and talked about various catalysts. I don't know if catalyst is right. I don't really like the word catalyst, but we talked about things that would compel you to revisit the expectations, let's say it that way. Compensation was not really part of that. But the key to me for compensation, incentive compensation, is that I want to make sure that executives are aligned with the interests of the shareholders, and that predominantly means that they're going to be good and thoughtful, judicious capital allocators. That's really what it's about, is capital allocation. Now, the ESG stuff is interesting because you can think about that at two levels. One is certainly the company level. So what actions or initiatives are they taking? And, Al and I wrote a paper for the Journal of Applied Corporate Finance probably about 5 years ago. And we argued for this idea of that companies should be extremely clear about their governing objective. And by that, I mean is, when a company is faced with a trade-off, can that company be very explicit about how it's going to make those trade-off types of decisions? And that would be things like, what's going to be prioritized. It could be things like time horizon and so on and so forth. And to communicate those broadly, not just to shareholders, but other stakeholders like employees or suppliers and so on and so forth. So I think that's one issue that I think rears its head a lot in the whole ESG discussion, which is important. And then the other question is, if money flows, could money flows either in or out of particular companies or sectors affect the valuations and hence affect the expectations priced in? And that may actually represent an opportunity. So, historically, sin stocks have been pretty good stocks to own precisely because they're sin stocks. So that's another interesting set of issues. So, and everybody's got they have different objectives, but yeah, it's a great question. Any other thoughts, questions? I shouldn't have handed out this thing because everyone's focused on it.
We have a lot of questions coming in from online. So if you're smart, can you talk more about intangibles? You mentioned this as a frontier. What intangibles are currently misunderstood, mispriced, and are any of them getting overpriced? Is ESG an intangible? Will at some point intangibles get overpriced?
Yeah, I mean, look, I think that almost anything can be overpriced from time to time, right? So I guess that would be that's part and parcel with the territory. I guess the reason I find this to be so important is that, at least I grew up in a world where we're very focused on income statements and things like margins and EBITDA and these types of measures. And we were able to really see investments showing up on the balance sheet. Really, they were investments and profits were largely segregated. And now they're largely commingled. And that's a problem if you're really trying to understand the value of the business or understand the prospects of the business. One of the solutions to that, and certainly I'm sure many of you do this, but just to be very explicit about it, is what I would call the basic unit of analysis. So understand in the most fundamental way how that company makes money. One good example, and Parker mentioned the SaaS companies, but one good example, we wrote a piece about this earlier this year, and there's a big burgeoning literature on this, is customer lifetime value calculations, right? So you say, it doesn't have to be a subscription business, but it's convenient for it to be a subscription business where you say, there's a cost to acquire that company, that's usually expense. And then there's a stream of cash flows we get from that company, from that customer over time, right? So there are revenues and we have costs associated with those things. And how long that customer sticks around, how much they spend while they're around, are the things that determine the economic value of that customer. So there's an example where if your customer lifetime value, your prospects are very attractive, the faster you grow, the more your current earnings will be penalized, right? Because all your investments are up front and all your paybacks are down the road. So I think that's okay. So, but Meredith, when I say it's a little bit of the frontier, what I mean is, I think that very few academics and very few executives have really thought carefully about distinguishing between maintenance SG&A and investment SG&A. Like that's the big area that's exciting. And actually, we have some folks here at Columbia doing some really exciting work on that. Now, the first group that sort of came around to this was a quantitative community, right? Because they were using things like price to book and their simple factor models. And they recognized that price to book had lost a lot of its relevance and the value factor itself had been doing poorly for a long time. It's had little sprints back in performance in the last year or so, but I think the data would show that when you introduce these intangibles into book value, you get a better signal. So we know that. So there's just a lot of devil in the details about how to do this more effectively over time. So I think that's exciting. And again, it goes back to the first principles that you guys are, you're buying a stake in a business. You want to understand that business, and to understand which things go in the right buckets is really important. I'll finish on this, Meredith. We have a report coming out in the not too distant future. And one of the things we talk about is that I think even the statement of cash flows, by the way, it's an interesting history because I didn't really fully realize all this. The statement of cash flows in the United States was not mandated as it is today until 1989. So it's a relatively recent adoption. And some academics looked at different accounting books and found that the vast majority of the emphasis was on income statements and balance sheets. But what we argue is the cash flow statements are actually very misleading. So I'll give you one specific example. The classic example of free cash flow, definition of free cash flow most Wall Street people use, is cash flow from operations minus CapEx. Now, by the way, that's a rough proxy for levered free cash flow. It's not the number that I showed you a few moments ago, but there are a bunch of problems with that number, as you might imagine. The first is stock-based compensation. So there's a big add back for stock-based compensation. Now, I don't think, by the way, it's funny because people used to argue, by the way, stock-based compensation should not be expensed at all. It just showed up as a footnote. And people were saying, of course, it's an expense, obviously. Finally, the FASB got that pushed through in the early 2000s. And even though it got pushed through in the income statement, now it's added back to the cash flow statement, right? Which makes no sense because it's obviously a legitimate expense. What I would argue is, for example, stock-based compensation is two transactions in one. One is the company selling stock. You might imagine they sold it to Goldman Sachs, for instance, and they take the proceeds and they give it to the employees for remuneration, right? So it's two transactions in one. So what I argue is that SBC should be not added back. It should be as a source of cash down in the financing section. The second one, interestingly, just a couple of years ago, 3 years ago, now all leases are required to be on the balance sheet. And it turns out, this is weird, that if you buy an asset, it shows up in investing. If you lease an asset, and again, these are effectively the same transaction, it shows up in the financing section. So again, you're understating investment. So that should go up into the investing section. And the third is what we've been talking about with intangibles, right? And by the way, we run the numbers, we do the case study of Amazon. And interestingly, Amazon's earnings last year were $21 billion. Our calculation of their net intangibles, so this is intangibles minus the amortization, was 18 billion. So we're saying that earnings or their cash flow from operations are understated by 18 billion and their investments are understated by 18 billion. So that should be shifted. So when you make these various adjustments, you see a very different picture, again, of how the company's generating cash, where that money is going. And again, hopefully giving you a better insight as to how the business should work. Anything else you got, Meredith, or anybody else? Or yes, please, thanks.
Hi, Professor. So in one of the slides, you're showing that using the DCF approach to figure out the expectation built into stock price. I wonder, do we need to thinking about what's the assumption that we need to use for the discount rate? And if so, how do we think about the discount rate that should be used?
Yeah, so we have a sidebar, by the way, talking about discount rates and forecast period and so forth. But I think that let's just go back to first principles, right? And this is how we build it up in security, at least my class security analysis. So when you think about the discount rate, what comes to your mind when you say, what is the discount rate? What should that reflect? Cost of capital. So what is the cost of capital? What does that mean? Anybody have? Yeah. The opportunity cost, right? Right. So opportunity cost, and I'll say what I think it believes, and tell me if you think it's different. That I have money and I can invest in this project, or I can invest in the next best project. It's basically going to be the same thing. And if I can earn X over here, I want to earn X or maybe slightly better than X, right? So it's opportunity cost. So I just never want you to lose sight of what you're trying to do here, which is understand the opportunity cost of that dollar of capital. Now, obviously, very simplistically, there are usually two components. One's a debt component, one's an equity component. Debt is pretty straightforward, right? Because debt prices are out there every single day. So you can do that calculation pretty, Bloomberg or whatever, you're going to be able to do that calculation pretty readily. The question becomes much more difficult when you start to think about equity, right? So we can get into, we actually just talk about the capital asset pricing model. You can get into much fancier things, but the key is for you to do as a business person, even forget about your investor hat, just as a business person, what is my best estimate of the opportunity cost of that equity capital? That's really the answer. So then whatever models you want to use, it could be a single factor model or multi-factor model or any other asset pricing model, or you can just say, I'm going to do this. Now, there are a lot of people who say something like, I'm just use one discount rate for every company, right, or something like that. And that's a very standard way to do things. Now, that I don't have a problem with that if you're trying to figure out price value gaps. But if you're really trying to understand expectations, I think that can be somewhat distorting, right? Because companies truly do have different discount rates. A biotechnology company and an old Procter & Gamble are unlikely to have the same cost of capital, right? So the opportunity cost is clearly different. So I'm appealing to you just as an intelligent investor, smart person, as a business person, to say, let me make my best estimate of the opportunity cost. So I don't ever want to lose sight of that. And that is the answer. People complain about the discount rates, but that is really ultimately the answer, is just do your best job of estimating what the opportunity cost is and then move on. Any other questions? Does that make sense? I hope everybody.
Why did you decide to write the updated edition? And what are the key messages you want to impart on those who've read the previous edition?
Yeah, I had lots of time around COVID. No, I'm just kidding. No, I'll just say that I it's interesting that I started teaching here at Columbia Business School in 1993. I was teaching these ideas right away, of course, based on creating shareholder value. And certainly when Expectation Investing, the original version came out, that was a text we referred to a fair bit. But a couple things came along. One was the world changed, slowly but surely. And I showed you obviously the different market caps, but there are other things like this, the world going from active investors to passive investors, the rise of private equity, venture and buyouts, the intangibles, right? So those things I think were really very material. And so I just thought so I just found myself talking about things that were close to, but not exactly in the prior version of the book. The other things I just learned a lot. So I learned about things like base rates, which I think are very important mental model. I knew a little bit about them, but I think I understand them much better now, 20 years later, than I did at the time. And and I also had a partner who was willing to go with me, which is Al Rappaport. Al's now in his late 80s, and he's just awesome. It's just, no one could ask for no better mentor or teacher. He's my teacher, by the way. I still ask him lots of questions so I can try to answer questions more effectively. And if I'm stuck on a particular topic, I just call him up and we usually can work through it, just talking it out. It's fantastic. So for me, there was another feature, which was it's a really a thrilling opportunity to work with a mentor. And that was also a motivation. So it was a combination of a bunch of things. And hopefully we'll be able to use this in our curriculum for years to come. And the case study, in fact, the gate was embarrassing. The gateway was our case study. Anything else?
Will this be available on Audible?
Working on that. I'm hopeful that will be the case in early 2022. It's the upside to that is, of course, we all like to listen to things when we're on the go. The downside is there are a couple of formulas and tables and stuff like that that make it less friendly for that format. But I would just say that the key is to sort of blend all these things together. And I really, if you're interested in some of these ideas, I would recommend going right to expectationsinvesting.com and going to those tutorials, because I'll just say when I read Creating Shareholder Value, the original version, those numbers, I mean, I thought the narrative made enormous sense, but the numbers didn't all make sense to me. And I had to recreate everything I saw in the book for me to really understand it as intimately as I had to. In fact, we're working on some other papers that are follow-ons to some of the ideas in EI, and I actually had to go back to CSV and redo some calculations even now to make sure I understood all the different concepts. So I find that to be, for me personally, very powerful to be able to get my hands into it a little bit. And actually, so that was another, updating all those things was also very fun. Yes.
Curious, why did you choose Domino's as the case study this time around? Did you think about other companies?
So I wanted a business that would be, so consumer businesses tend to be fun businesses to talk about because people can relate to them for the most part. And as you know, do you know Domino's pretty well? Yeah, so it's it's a great business, right? So it's just a very good business, and it's pretty easy to explain and so forth. And there's an interesting sub story. Maybe you could tell better than I, but I think that when you think about the basic unit of analysis for Domino's, I would argue that it's basically franchise health, right? So we need to understand, are the franchise doing well, because the franchise pays some revenue up to the parent. And there was some interesting, I think, pretty good work, not just from like research people, but also academics on that basic concept. So, and the company itself shares a bunch of it too. So those are basically the formulas. That it was a pretty straightforward business to understand. And I'd be curious, chapter 4 is about strategy. And of course, chapters 5, 6, and 7 are we basically run through the steps, and we try to animate the ideas using Domino. So I'll be curious if you think that our strategy assessment stuff it's obviously what we're doing in the book is going to be a level simpler than what you guys would probably do when you're really diving into a company. But I think that directionally it's going to be all very much the same. So, and then the other thing I think it's unlikely Domino's goes bankrupt. I think it's much more likely to get bought out by somebody. They go private again or something like that. But it's an amazing business. So we did the case studies for about a year ago, and the stock's around $415, $420, something like that. And then it went down to like 325 or 330. Now it's, I don't know, it's the high 400s, 485. It got to in the 500s. Now it's 485 or something. Anyway, but I think this idea of consumer was a brand name, consumer, understandable business with an interesting twist with a basic unit of analysis for the motivating factors. I'll say one other thing, by the way. The other thing is I didn't want a business that was going to get crushed by COVID. It's going to sound weird, but it's just a practical point of view, right? Which is you say, oh, here's company's great, and their revenues are down 20% because of COVID, not to reset everything. So Domino's obviously sort of had a little tailwind from that. So it's not like they crushed it, but in other words, it sort of seems fairly linear versus a sharp drop off, or other companies that had these sharp increases. Yeah.
You spoke about private equity and venture capital, right? Do you feel that we're now moving into a world where public equity is in the space, or they might not be a preferred asset class?
Yeah, it's a great question. So did you see the thing we wrote last year about this? I hope you have. If you haven't, I'd be super happy to share it with you. But we wrote this was my true COVID project. This I did on the weekends, most of it. The true COVID project was we wrote a big piece called Public to Private in the US. And we limit it to the US, by the way, because you can obviously, this conversation can go very far afield very fast. One of the points I would make, because I hear your point, and that was, as you know, that was part of what I was arguing, which is the number of public companies today is 2/3 what it was when I wrote the first book, right? So we just have fewer public companies. Now they're bigger and they're more profitable, but there are fewer of them. And like you said, there's a lot of wealth created in the private markets. You think about even companies, Facebook didn't come public till it was a $100 billion market cap. Uber didn't come public till it was a $75 billion market cap, right? So that's a lot of money for people to make in private markets. That said, here are the numbers, roughly speaking. The market cap of the US at year end 2020 was about 41 trillion. Today, well, I don't know after this correction, but today it's probably 46 or 47 trillion. The assets under management for the buyout industry in the US is 1.7 trillion. So let me just say that again, 41 trillion and 1.7 trillion. The assets under management for the venture industry is 550 or 600 billion with a B. I'm very good friends with Bill Gurley at Benchmark Capital. I twisted his arm to give us a blurb for the book. Benchmark's, they 2020 announced a new fund. It's 500 million with an M, $500 million fund. So us mortals can't get involved with that, right? So it's going to be Harvard and Yale and all those guys, but it's not going to be us regular people. So if your job is to earn dollars, actually public markets are really where the action is. And it turns out, I think I ran the numbers, if you do FANG-M, so the FANG stocks plus Microsoft in 2020, they increased their market cap. I think I'm gonna get it wrong, but by about $3 trillion. So the increase in their market cap was bigger than those two other asset classes combined. So that's another way to think about that. So I don't know that it's going to go away. I will say though, it's obviously very competitive. And so if as a student, if you're saying, gee, where can I be the smartest person in the room? By the way, it's hard to be the smartest person in the room in privates, obviously too. It'd probably be like, are there niches within the US public markets? Are there, I'll probably say, I'll go international. Are there markets around the world where I can go in there and draw my expertise and be the smartest person in the room? So I hear the point because it's very competitive, you state the obvious, but it's a fascinating topic and I love this, right? And then, by the way, I wrote a piece about the declining number of public companies in the US, because by the way, they're way down since the peak was 96 or 97, they're way down from the peak. And I was like, oh man, the moment I publish this, it's going to turn around, right? So we published this thing last summer and I'm like, oh man, wait for this SPAC thing to hit, right? Those SPACs, they were coming out this like fast and furious. And then the first quarter, massively fast and furious. And that seems to be reversed. But interesting, like the guy who does the work on this, Jay Ritter, University of Florida, does not count a SPAC as an IPO until they demerge, T-SPAC, till they merge with somebody. So in effect, until these deals get consummated, we're a little bit in a holding pattern. But even, again, the reason the number of companies goes down is M&A typically. There's some bankruptcy, but mostly M&A. So that's the question, is the trade-off between new companies and M&A. So it's all very interesting. And obviously, as a Counterpoint Global, we have a very large public investing funds and so forth, but we also do venture stuff. So and have done it for a long time. So I think there is value in doing both of those things. It's a great question. We done, Maria?
Yeah,
We're
we
done.
have to grade the quiz.
Yeah. So I don't. Should we end? We could probably end the webinar,
Yeah.
right?
Thank
So
you.
thank you very much for everybody that participated today. Thank you.